The platform for top economists, analysts, and industry experts to review and analyze the interplay between macroeconomic policies and programs taken so far, recommendations made in the past, and their impact in terms of supporting economic growth, business prosperity, and household welfare. The conference aims to assess the impact of Nigerian reforms over the past 2 years, the shifting dynamics in the uncertain global economic landscape, and the outlook for the pre-election year of 2026, highlighting the opportunities and threats. Before we proceed, we need to set out a few housekeeping rules to guide the webinar. For all technical issues, kindly use the chat forum and direct sync to the host. All attendees' microphones are muted to prevent interference. You can submit questions via the Q&A icon. Decorum standards within our governance ethos are in place and will be activated even as we encourage everyone to express themselves. Finally, do note that this webinar is being recorded and live streamed on Web TV YouTube page and Proshare platform. As a measure of the citizens' pulse, we will be conducting polls intermittently on the Zoom platform. The results of the polls on this platform will be immediate. I would now like us to participate in our first poll for this conference. Thank you. Thank you to our audience for participating in the poll. I would now like to invite the founder and chairman of Proshare, Mr. Olufemi Awoyemi, for his opening remarks.
Thank you very much, and good evening, distinguished panelists and our listening audience. This year, 2025, has been a very eventful one for us. Nigeria seemingly turned the corner. We moved from a risk-watch model to a recovery-watch trajectory. It is noteworthy that this is the first time Nigeria will recover from an economic crisis without a fiscal and global response. And I think that point must not be lost on everyone. And one, it seems as for the first time we are also not moving out of our situation premised on law, but perhaps on policies, not different from by design. As part of the efforts of providing clear society which will be sharing in the next few minutes, and some of which will be producing after this event, this distinguished panelists have put together to take a look at some of the key issues, especially the disconnect, what we call the transmission and translation gap between the microeconomic indicators and the macroeconomic indicators. That gap is significant in the country of 200 plus million population. More importantly, however, is that as we speak today, we must not overlook the major achievements that have been recorded. as a country. We have had access to this. That is not something easy to achieve. It should not be a problem. Secondly, all our literacy is macroeconomically important. But yes, we had a decision to one of those laws has predicated on the fact that we are waiting to see what happens in December. But most importantly, also raise this question about how well the CBN itself believes in the 16.5% inflation or the adjusted inflation of about 22 to 26%. Whichever way it works out, the research services becoming our position today. But for the purposes of this meeting, it is important for us to understand that this conversation will help as Nigeria puts together an MTN 2026-2028. Most importantly, however, is that I am looking forward to learning from the perspective of the legislative arm, which Architect Kola Ogunleye, from our friend Dr. Alaje, who has been very consistent over the years on the belief in fundamentals of economic implications and execution, and most importantly, our distinguished Dr. Bajomo and Dr. Ewa, who have always been very clear as to how we should move. On that note, I welcome you to the 50th conference, and I hope we have a wonderful celebration. Thank you very much.
Thank you very much for your very insightful remarks to set the pace for what promises to be an enlightening webinar, especially the expectations that we should look at what are the transmission and translation gaps between the macroeconomic and microeconomic indicators. Very critical at this time, and we look forward to a robust conversation. And that's why now I'd like to invite the head of Research Services Proshare, Tosin Ige, to give us a brief presentation on the Nigeria 26 outlook report. Are you the floor to your
Right. Good morning, everyone. Good morning, Ottoabasi. And very quickly, I'll take us through the contextual, the macro and microeconomic data as the contextual understanding for discussion today. So I won't be doing much talking. I'll just allow the data to speak. So, but very quickly, let me say that being an outlook webinar, our belief is that outlook are like the weather forecast. They can be instructive and giving the direction and all the positive parts, but not conclusive. So in doing this, I will take you through in 4 segments. I'll look at the geopolitics and the geoeconomics from the global and the continental space, and then move to the micro and the micro segment of the Nigerian economy, then look at the reforms in the government so far, and conclude it with an outlook on the Nigerian economy. So very quickly, moving to the global, for I think about 2 to 3 years now, we have been at the forefront of saying that the geopolitics and geoeconomics have become dominant force in the global space, and the two have actually become inseparable at this speed. And these two are creating a new global order, of which you could see that there are a number of blocks now. So the world is more like moving from unipolar to a multipolar system, whereby we will see the US, such that the US at this period challenging the new global order with its investment and trade strategy. But one thing that we can be sure of is that the world has actually changed from what it used to be from 2000 to 2024. Like you see the chart we have there in 2000, the global relations dominated by the West, US and Europe. But now looking down to 2024, 2025, we see China taking much of the space. But for the factors that have been driving this, for the tailwind, we actually saw that from the global economy, we see growth being resilient despite all of this. We see inflation competing across the globe and across tech deals as well as trade deals. But if you look at that same thing, we look at the continental and the domestic space, we'll see that this same factor is actually driving even the African economy as well as the Nigerian economy. So these factors have been supporting growth in across the space. But for the headwind, we saw that the geopolitics we talk about, and then the debt level on the global scene. The same thing when you come to the continental space, which is the African space, you see political instability, social unrest, and of course, when you come back to Nigeria, to see social deviances, you see insecurity, all contributing. And these are the risk factors that we see across the three spaces. But as I mentioned earlier, the global economy have actually been able to ride on a number of themes that we have seen in the current space, talking about the wealth transfer that is happening. We've seen that the airlines are moving their money into hard currency. So it's more like there is a commodification of the economy, of the global economy now. The airlines are moving their money to the commodity space, while the middle class are almost non-existent. It's one of the themes we have read in the global economy. We've seen political uncertainty also with the trade flow and all its consequences. We see monetary tightening, and even though there is currently that easing now because of the moderation in inflation, we see supply chain restructuring also happening. We see market volatility with what some call that Trump always chicken out. You know, he launches his trade policy and then the market reacts. He goes back on the policy. So we've seen that market volatility at play. We've seen what some believe is AI bubble, and of course there is the counter argument. We've also seen the gamification of the investment also as another factor, as another theme that we actually read in the global economy now. And then the multi-layered global recovery, as we mentioned, we will look at our own economy in that light also. And of course, as I mentioned, we've seen the tech also being a dominant force in the global economy. Those are the themes for the global market. But when we come down to Africa, what we've seen is that Africa is, as I mentioned when I was mentioning the headwind and the tailwind, there is also the recovery in Africa, and perhaps some are linking it to the fact that Africa is the quest in all of the global rivalry that we're seeing now between the West and China. And then, of course, Africa GDP has been forecasted to grow north of 4%, and with the space of our solid mineral and our soft mineral, we see that we are the quest in the global new order that is at play now. And of course, when we also, as I mentioned, it's going to be database just to present us the data. We'll see the top 20 economy in Africa. We'll see where we are currently despite our rebasing. But by and large, the African economy has been doing well, particularly those in the north and a selected few in the south. But again, the resources has actually kept us also alive, even though we are still playing the primary segment of it. But all of these have implications for the domestic economy, for the geopolitics, because we're an oil-producing country, and of course, our regional leadership means that we have a big role to play. What I mean Nigeria, we have a big role to play in the geopolitics. In terms of fiscal policy, we see that the structural reforms and then the fiscal reform that we have been having is actually attracting global attention, and because of that, we'll continue to be we hope that the structure and the fiscal reform will continue such that we'll get the global attention in that light also. We see moderating inflation where we believe that as it is also in the global scene, RCBN, just like they did yesterday, they will continue to anchor inflation expectation with the monetary policy rates. Now, the elections are also, as I mentioned, alliances are quite fragile now, and we see we are also entering the pre-election year in 2026. We believe also that Nigeria will also take the global attention with our election. Alliances are fragile. China is trying to fraternize with us. You see the US also trying the same thing, but it all boils down to how we are able to manage our electoral space. And of course, the trade bloc, we've mentioned that we are also getting attention because of our resource endowment. But moving quickly to the Nigerian economy, what we have read from the Nigerian economy is that I think the chairman pointed to it during his speech, that what we have seen is that the Nigerian system has moved from risk to recovery. And of course, this is predicated on a series of our reforms and of course, price stability and a whole lot of others, which I believe are panelists to discuss. But one thing we can be certain for is that the recovery is actually filtering into several areas of our economy. We've seen us being removed from the gray list. We've also witnessed series of upgrade from rating agencies, the likes of S&P 500, Moody, Fitch, all of them having one upgrade or the other for the system. Of course, a testament to the fact that we are in a recovery space. So that defines us as a nation in recovery. And of course, this is the macroeconomic data, which also support the fact that we are in recovery. We see strong growth, GDP at 4.23. We've seen PMI all going up 55.4 as at October from the Islamic IBT's PMI. We've seen inflation moderating also, and a whole lot of price stability and policy rate also. We expect policy rate to actually go down in 2026 if inflation sustains its moderation. And then I think I've mentioned this, that we've seen our exchange rates reserve. I think the CBN governor mentioned we are close to 46 thereabouts billion in terms of our reserve currently. So all of this point to the fact that we're in the recovery stage. But when we look at the when we trickle it down to the subnational, one thing we also notice is that the fiscal reform and the recovery that we're having is actually also moving. We're seeing the gain from the subnational. Data point to the fact that there's a shifting balance of power to the subnational. We've seen that in our FAC, whereby the states are having more shares of the FAC allocation than the federal government, even though the sharing formula hasn't changed so well until, of course, the NTA, that's Nigerian Tax Act, come into implementation next year. But we've seen this shifting balance of power, which shows also, well, it then is now left to the subnationals to actually take advantage of that in terms of profiting with the recovery we are seeing. But again, one of those things, we also see the MBS classifying the Nigerian economy into 46 sectors. But one of those things we have argued at Proshare is that we can actually streamline this sector into readable sector, and of course, where we can follow it, we can integrate some activities that are together such that we'll be able to monitor and, of course, manage our resources proper. We have the 14 economy, and we see growth in the agricultural, digital, energy, creative, lifestyle, and mineral, as well as trade economy, whereby these are the growth areas that we expect that based on the reform, the macroeconomic reform have been in play, but we hope that, of course, going into 2026, the government will then concentrate on sectoral reform such that we'll be able to boost productivity from a number of this sector. And in doing it well, we believe we can streamline it further into 14 sectors so that we can actually manage it properly. But in all of this recovery, we'll see that there are still pain points for the micro segment of it. We have always argued that the micro segment is the household is at the tail end, at the receiving end of all of the micro policy. And of course, the way the individuals, the household are feeling the economy often dictate the perceptions of individuals about the economy. But when you look at the micro segment, data suggests that there are still a number of pain points. Even though we've been able to bring down inflation, food inflation, we see that the electricity bill, the cost of health diet, the cooking gas, all of these remain a pain point. Even cost of credit remain a pain point for household. But we feel, again, we believe that actually going into 2026 is one of the things that the federal government would actually take a look at. But very quickly, looking at the government reform, our understanding is that we are in recovery, as I mentioned, and this just shows that recovery state, that these are the triggers. We've seen a number, the government started from the subsidy removal to electricity reform, and a whole number of them, about 14, we actually suppressed them into this 14 to say these were the reform, and these were the pain point. The middle column is the pain point. Before this reform were launched, we have growth, currency depreciation, inflation surging, and then a whole number of things. But when you look at the last column, these are the recovery. And from the pain point, we can actually see definite growth. So data is actually pointing to the fact that on the micro space, we are actually having that recovery. But let me say that those who are pulling the recovery are actually what Proshare terms the decagon of power. These are the people that are close to the government, and these are the people that have been driving the reform. Although our analysis also says that they constitute about 45% of the budget, which of course we can it shows anyway that the government has it handy for him to move anything in the system. So it can actually, when we see government moving in a certain direction, we can be certain that with the decagon of power, it can actually push through, because those within what we say the decagon of power, which is like the substantive or the substantial ministry, they are actually within the reach of the president. These are the people that have been moving it, and we believe because of this, we could actually see that sustain the government sustaining that reform going forward. But again, there are risks that we see that with this reform, we are saying that what could go wrong, some of those things that could go wrong is actually the change of government. We could see prolonging of the key man is also another risk, foreign interferences, religious conflicts. These are what we say that can go wrong and actually water down the series of reform, about 2 years reform that we've been able to achieve, the recovery that we've achieved with the reform. These are what can go wrong and actually bring us to where we do not like. But we hope, again, that the government will actually see this and try as much as possible to guide against it. In conclusion, let me conclude by saying that in the recovery we are seeing, we are not alone. The Goldman Sachs also forecast that by 2050, 2075, Nigeria should be part of the top economy. And of course, they put the drivers there because of a large and young population, the potential in agriculture and energy, as well as the emerging technology. But they said, again, just the way we have also raised it, that political instability, infrastructure deficit, and the need to diversify beyond oil are actually the challenge. They are the risks that they foresee. But one thing we are so certain also for is that if we are able to address these challenges and leverage those drivers, we are also confident that we are able to also move into the big players. But on the outlook says, we see growth also. We're positive about growth, we're positive about PMI, we're positive about inflation, we're positive about exchange rates, and of course, some of our experts that we have on the panel give us more into that. And then finally, the growth project, we are also able to aggregate some of the projections by some analysts and of course international agencies. And from there, we could also see that everybody is positive that nothing less than 3% is what Nigeria will do going into 2026. And of course, in inflation, we should be edging close to single digits, if not single digits, but on the average for 2026, our inflation should be within the current range that we have it as of now. And of course, exchange rate stability, everybody is also bullish that will not move to the historical high that we have, all those 1.8, 1.9, that we should settle between 1.3 to 1.4 going into 2024. So as we mentioned, we are in the recovery, and we believe, we remain positive that the Nigerian economy will sustain the recovery into 2026. Thank you.
Thank you very much, Tosin. Tosin Ige, the Head of Research Services, for a condensed and insightful overview of the Nigeria 2026 Outlook Report. Very clear that there are structural and fiscal reforms, which has been tracked very well, and we're in a risk to recovery mode. But most importantly, just like the chairman said, the need for transmission from macro to the micro level. We need to see that impact. And of course, the shifting balance of fact to states, and most importantly, the decagon of power. That's something very interesting to study. And lastly, the fact that we are bullish and there's positive indicators for growth. But we'll keep track of that, and our speakers will give us more insights into that. I know our great audience are eager for the conversation proper, but I would like to invite us to participate in the second poll for the conference. Thank you for participating. I would like to welcome our esteemed speakers for this edition of the Proshare Economists Conference. Architect Kola Ogunleye is an architect, chartered accountant, and currently a Senior Legislative Aide at the House of Representatives. Dr. Bunmji Bajomo is a Pan-African banker and financial advisor. Dr. Alaje is an economist and Chief Economist of SPM Professionals, and Ms. Chinwe Egwim is an economist and World Economic Forum global leader. It is great to have all of you for this webinar. Thank you for being a part of this conversation. We'll quickly take our third poll before our speakers begin to engage. Thank you. Thank you all for participating, and we will now like to inform our audience that our speakers will be addressing the following focus areas: perspective and interpretation of geopolitics and geoeconomics convergence and flashpoints in 2025, Africa's geoeconomics and geopolitical landscape in the current global order, key assumptions and outlook on the global economy for 2026, Nigeria and Africa's trade relations and imperatives for 2026, interpretation of Nigeria's macroeconomic trends and indicators, bridging the macroeconomic and microeconomic divide, economic and sectoral growth outlook and growth areas, and lastly, outcome scenarios for Nigeria in a pre-election year. So I'll begin our first round of questions, and Ms. Egwim, this goes to you. The subnationals have witnessed an increase in FAC allocation, just highlighted by Head of Research Services, the shifting balance to states. Just looking at the data for October 2025, the allocation was 2.094 trillion naira. States received 689.125 billion naira just for October. But however, the states have showed a high reliance on this relative to internally generated revenues. What is the way forward for subnationals to achieve more productivity and inclusive growth at the grassroots level, which is very important?
Thank you so much for that question. That's a really good question. Yeah, FAC allocations will continue to fluctuate, but the underlying issue remains the same, which is that most states depend heavily on monthly transfers to function. And FAC does keep government running, but it cannot deliver widespread jobs. It cannot deliver on stronger communities or even sustainable development. So the real shift now is helping subnationals move from receiving money to actually creating value. And I think from my vantage point, I would give just a few points or pillars. And the first is really building local productivity, not just government spending. So states do need to turn their natural strengths into engines that generate activity at the grassroots. An example I would give is Ogun State, which has been able to use its location to attract manufacturers moving away from Lagos congestion. And in Ogun, you find industrial estates that now drive its IGR to an extent. Kano is another example. In that state, Kano is leveraging its leather and garment value chains, improving small-scale production to an extent. Of course, there's vast room for improvement for both examples that I've shared. But what this really means is that grassroots productivity rises when states invest in processing plants, in storage hubs, in feeder roads and structured markets, not just administrative overheads. I think the other pillar would be diversifying IGR. For states to genuinely diversify their IGR, the starting point is expanding economic activities in ways that are safe, practical, and suited to their realities. Many states have strong potential in agriculture. They have strong potential in solid minerals, local manufacturing, specific services, tourism as well, and digital trade to an extent. But insecurity has made some of these sectors or some of these suggestions that I've just put forward a bit difficult and unpredictable. So diversification must be done in a way that reduces vulnerability. States can deepen revenue by just developing secure agro processing hubs instead of relying on open field production. perhaps by formalizing local trade corridors with proper security and logistics, by investing in small industrial clusters where I would say activity can be monitored and protected, and by expanding digital services and permitting systems that are less exposed to physical risk. I think the next pillar I would mention is to strengthen credit worthiness to attract long-term capital. Most progress at subnational level on a global landscape, when you look at subnationals mirrored in other countries, you'd see that those states or subnationals are funded by patient capital, not just monthly allocations. And what these credible states do is, one, they publish timely budgets and audited accounts. Secondly, they do adopt a treasury single account, create dedicated debt management offices, and borrow only for bankable projects, tied investments. I'm not saying that in Nigeria we don't find this, but it's not, you don't find that uniformity across all 36 states. The next is putting women and youth at the center of economic programming. If states are serious about driving productivity at the grassroots, they need to have, or they need to design programs around the people who actually run local economy. And in most states, that is women and young people. They dominate retail trade. They dominate food systems, transport, micro enterprises, services, and emerging digital platforms to an extent. So when this segment of the population is equipped with predictable operating environments, with basic infrastructure, secure market spaces, small scale financing, and skills, that that links them to higher value activity, and the entire local economy becomes a bit more stable. So that would also contribute. I think my last would be improving basic governance. So really nothing delivers more impact if or when subnationals struggle with development outcomes. The issue is not often because of lack of ambition, but lack of execution willpower. Basic governance is what converts plans into real progress. So when states clean up payrolls and automate payment systems, they stop losing money to inefficiencies, and they're able to redirect those resources into classrooms, into clinics, into rural roads. When budgets are transparent and predictable, businesses are able to plan better. Banks are able to lend with greater confidence, and development partners are able to deploy more capital. And when state governments create structured feedback channels with citizens, indigenous members of community, local businesses, and they're able to design programs that solve real problems rather than just adding new layers of bureaucracy. An example would be Rwanda. Rwanda's performance contracts model shows how accountability and follow through can dramatically improve delivery capacity. For Nigeria's states, I would say that governance is a technical box to tick. It's the simplest, fastest, and most cost-effective way to unlock resources and, just make grassroots economies more productive. I'll put a pin. I'll pause here.
Thank you very much, Ms. Egwim. Very clear that states need to build local productivity. You highlighted Ogun and Kano states, diversify their IGR, which is very important, by expanding economic activities, boost their credit worthiness, tap into the women and youth, and of course, provide basic governance. It's very critical because subnationals drive the economy. Thank you very much, Ms. Egwim, for your opening statements of the subnationals. Very pivotal to our development. I'll go to Dr. Alaje, and Dr. Alaje, for the next 4 minutes, the Monetary Policy Committee took its bold step to cut the interest rates at the September MPC meeting, and there was expectations, but it put a hold, like the chairman of Proshare mentioned earlier, at 27%, the monetary policy rate in the last meeting for the year, which was yesterday. These are amidst easing inflationary pressure. And of course, adjusted the asymmetrical corridor, plus 50 minus 450 basis points, retained other parameters. What is your reading of our current economic reality, both monetary and fiscal? And what is your assessment of the monetary policy transmission to the real economy so far?
Yeah, let me say a very beautiful morning to you, and thank you for having me. I most sincerely also welcome the chairman of this important organization and extend my greetings to co-panelists and the audience. Thank you once again for having me. Yesterday, the Monetary Policy Committee retained or held rate at 27 basis points. Most parameter, monetary parameter were also held the same. This has a lot of far-reaching implication. Holding rate does not mean having no position or having no decision. It's actually a decision in itself. Before that time, recall that in March, we have had inflation. Nigerian inflation has gone up to about 34%. 34% was the rate. Up until the time we had the National Bureau of Statistics adjusted the base year. Apart from the base year, we start seeing some gains. I think the first drop in inflation was by a whopping 10%. But the good news is that the Statistician General had mentioned that this reduction does not necessarily mean that when you get to the market, you start seeing this difference in prices. It is simply because we have changed the base year. It's an exercise that the Bureau of Statistics has right to embark on. So that said, we started seeing reduction in inflation. In fact, in recent time, between September and October, we saw 200 basis point reduction in inflation from 18.02% to 16.05%. That's major. That is why perhaps many analysts thought Monetary Policy Committee will cut rates by 50 basis points to about 150 basis points. But what we saw was to hold rate constant. So what is the implication? We have seen stability around FX market, which I'm happy the chairman and Mr. Tosin Ige, your lead research person, has also emphasized that. As of a couple of months back, we saw Nigeria's foreign reserve increased about $42 billion. As we speak, in recent research, taking a monthly average, it was about $44 billion. That is huge. That has given us about 10 to 11 months cover for imports. So which I think these are positive things that have also affected inflation. We have also seen that prices of some food items have reduced up until recent, that we have seen heightened insecurity because Nigeria has successfully joined countries, you might say, they are currently experiencing durable disorder. This durable disorder was common with the Middle East and a few African countries, especially in the East. But with the reset happening, we can say Nigeria has joined a country of durable disorder. And you have seen America also said, President Trump tweeted that Nigeria is a country of a particular concern. I feel that this, among so many other reasons, is why that rate was held yesterday, because of new macro occurrence in the economy that were not envisaged as of the last meeting. So that said, what is now the implication of these on credit? What is the implication on employment? What is the implication on every other macroeconomic parameter? And perhaps if I have time, you said 4 minutes, I can take that to fiscal implication and how this translates to the overall economy. First, cost of borrowing will remain very high. I know the cost of borrowing now is high. And when I say cost of borrowing, it might be good to limit it to commercial or DMBs, deposit money banks, because if you take it to microfinance bank, you are talking of 60% per annum. If you take it to money lenders or those that say they have private lending, it might be going to about 120% per annum. How do businesses compete in the face of these high costs of borrowing? With their foreign counterparts? We say Nigeria has about 50% of all finished products are imported, and I'm just being charitable. In the real sense, the number may grow as high as 65% or 70% is okay, depending on authority. But to be charitable, we can say 50%, half of what is imported to Nigeria. Why? Because manufacturers in Nigeria would have also loved to produce, but from the institutional and structural misalignment, which includes energy supply, even though we have seen some improvement in recent past, but it's still not sufficient in terms of what is distributed for producing zones. Three is coordination. Secondly is coordination. There seems not to be coordination among the subnational, which you rightly mentioned, and your researcher, Mr. Tosin, also alluded to. There's no coordination. We are seeing some increase in VAT and in FAC allocation, but this increase is not translating to sufficient infrastructure. Apart from 7 states that we have seen significant growth, about 3 in the north, that include FCT, and 4 in the south. The rest, there is only a marginal increase in the investment they have done in the state. So it's not substantial enough to say that the impact of the reform will be felt and it will be sporadic. And if you compare that with what Bank said about the negative impact was very obvious on the people. 139 million people is what World Bank said are now living below the poverty line, according to the World Bank report that came, I think, last month or the month before. So here is it. The structural reforms had some impact, and I must say that some good impact on the economy, but it also had a side effect. So holding rate would also mean that for now, we need to watch what the economy says, because when you disaggregate reduction that is by more than 50% of what we had in March, the question many Nigerians will ask economists will be, if truly inflation has reduced from 34% to 16%, why is it that we are not feeling the impact directly on prices? House rent remains high, transport costs remains the same, and so on and so forth, even though we've seen some marginal reduction in food items and a few other things. So the thing is that truly food items came down, but what accounts for high inflation, reduction in inflation, I beg your pardon, is base year adjustment. That in itself is not bad, even though it might give some concerns. It's not bad because it boosts confidence. Now, why do I also think that this reduction, the holding rate, might not necessarily be bad? It might actually be good. It's because of when you disaggregate the kind of investment Nigeria has attracted, foreign direct investment, and if you pull that into different components, investment in real sector, one investment, portfolio investment, another investment. The largest of the three is a portfolio investment, which of course has something to do directly with high interest rate. If the interest rate is lower, then you can say that those foreign investors might leave, especially in the short term or in the medium term. Perhaps when we're able to balance, we're able to have a robust reserve, which is growing sporadically now. At that time, we might be looking at reducing interest rate. But the security concerns, it's a major thing, a major concern for Nigeria this time. And I hope that Nigerians will unite together, around the government to ensure that we combat this insecurity. For fiscal authority, the ritual is almost here, talking about the budget and also talking about fiscal activity, especially what is shared at FAB. For me, I think subnational, about 30 of them, about 29 of them, properly speaking, we need to do more in terms of investment, because the jobs Nigeria are looking for, the creation of opportunities Nigeria are looking for, it's around that environment. Then trade authority, I've seen that Nigeria is having improvement in export, but beyond this, beyond the export in naira denominated amount, we need to do more in terms of manufacturing. What will take us completely out of economic quagmire, we don't find ourselves here, is if subnational can organize themselves in region. We've seen what Southwest governors have done with their development commission, is to come together to say we need to protect our region from having influence, from allowing insurgents to get to us. I think other regions beyond insecurity should look at how do we transform this this region into economic zone for production, for manufacturing, for processing. At this time, we can say, if we are able to do this, we would say that certainly Nigeria will come out of economic quagmire soon enough and will not return there anytime soon.
Thank you very much, Dr. Paul Alaje. Of course, you'll be proud as someone from the Southwest region to see that that region sets the pace. Recently the Southwest governors met and they're strengthening security, agriculture, and ensuring that that region, the corridor, is pivotal to national development. You've also highlighted the fact that though the inflation is reduced, there is that concern, is it connecting with the microeconomic activities? That's why this conversation today should be able to address that linkage. And of course, the fact that Nigeria, in a, as you put it, a durable disorder, we need to address security. And you acknowledge that there's effects on market stability. The reserves have seen accretion, about $46 billion. But again, we need to reform and we need to attract investments driven by subnationals. Thank you for your opening statements around the monetary policy. We'll still come back to you on the alignment. For Dr. Bajomo, some economists have called on the government to unlock value through the listing of state-owned assets and enterprises on the capital market. As a financial expert, what is your assessment of this proposal And which specific assets or state-owned enterprises would you prioritize for financialization to boost our reserves and revenue? Mind you, the Bureau of Public Enterprises and the Ministry of Finance Incorporated have been having their rounds of meetings around this, but we need to really see traction in that. You have 4 minutes for your intervention. Thank you, Dr. Bajomo.
Thank you, moderator. Thank you, House. And good morning, everyone. I stand on existing protocol. So thank you for your question. In terms of the capital market, investment climate, and what the government needs to do. Number one, we all have to know that the stock market serves as the barometer for the national economy. A robust and deep capital market indicates investor sentiment, the level of economic activity, and the confidence that the investors have in the economy. So any measure that goes in the direction of enhancing the depth of the capital market will definitely be investment positive. But in terms of asset listing and what it can do to bolster the level of development of the capital market and the investment landscape in Nigeria, it takes my mind back to the agency of government that is actually saddled with managing of the government's global assets, and also tasked with taking an inventory, a comprehensive inventory of government assets. And that is the Ministry of Finance Incorporation. So the Ministry of Finance Incorporation is the agency that is legally, sole agency, that is legally empowered to manage and grow government investment across over 130 asset classes, and also to manage this asset. And in identifying which assets can be privatized, can be listed on the stock exchange, it still falls under their purview, in addition to whatever they are doing now in real estate, enhancing the depth of the real estate market or making housing available for the citizen. I would say their core mandate is what can actually take us from a perpetually borrowing economy to an economy that can actually moderate its debt and presence on the Eurobond market or debt market globally. And why do I say that? With the should the MOFI be able to actually identify, undertake a comprehensive review, and then classify the assets into those with prospects, those that are deteriorating, and those that have gone moribund. It allows the government to effectively appraise the status of the asset, identify those that have strong earning capacity. Those can be easily commercialized or financialized, like you rightly put it, and then those can enhance market viability. Should government be able to do that, then it can actually mean that sometimes some of the debts that we are seeking, like the recent 2.2 billion that we raised, perhaps we don't really have to raise it. And if I must choose in terms of which asset to classify, I will look at number one, the Nigerian National Petroleum Corporation, right? Not because of their $5.4 trillion or $3.3 billion net profit that they have declared, which everybody has been chorusing in the past 2 days, or in terms of their net profit margin that has gone to around 12.5. But I will look at precedents in various markets and in various economies that are oil-producing economies like ourselves. And I look at Saudi Arabia. Yes, Saudi Arabia produces well above 11 billion barrels of petrol per day. But we have to look at best practices, because if you remember in 2019, Saudi Arabia, through their oil company, Saudi Aramco, actually listed over a landmark 100 billion IPO, which on a net basis actually fetched the government of Saudi Arabia close to $40 billion. And then if I say Saudi Arabia is way off, then we look at Petrobras of Brazil, which on a daily basis produces about 2.9 billion barrels of oil. From Petrobras privatization as well, the government actually made significant sum of close to $9 billion. In unlocking values and NNPC, and I'm happy that the government has taken a path towards that direction, with the changing of it being from a public-owned enterprises to an incorporated entity in 2019. That was a first major step, but it's not where the company should be or where they should be. Recent financials also show that the entity is on the right trajectory, but should government be able to unlock value inherent in the NNPC, maybe it could fetch between 5 and 10 billion to the government from part privatization of the entity. And should that be, if we are able to unlock 5.5 billion or 10 billion from NNPC, then what business do you have in the Eurobond market raising money at very exorbitant rates? And it just follows from precedent of people. And then if I take it further from that, if you look at the inefficiency associated with the entity, yes, it's being curated, it's being corrected, is way far beyond where it was in 2019. Recall in 2019, where the oil price moved from an average of $68 to well above $116 by the end of Q2. As against what we saw with Saudi Aramco, whose performance actually was over 5,000% better than what Nigeria did, and Petrobras that had performance improvement of well above 1,100% above what Nigeria did. In that year, despite movement from $68 to 116, Nigeria's NNPC's net revenue was actually zero, meaning there was nothing to share. But thankfully, now we're talking in terms of 3.3 billion of net profit. So that is one asset that the government can unlock. There are so many more. You just need to look at the landscape and look at so many deteriorating, unused, underutilized assets that dots the landscape from Lagos to Abuja to everywhere. If those could be ascertained to either for privatization, part privatization, outright sale, or commercialization. Imagine if you look at the one in Ikoyi, sorry, the name escapes me now. You can imagine the value you can unlock from that, but that edifice is there, just gathering dust and doing nothing. Then look at the Nigerian Railway Corporation. The government effectively, by part selling some of the assets of Nigerian Railway Corporation, can also raise between 2 to 3 billion. And then look at the Nigerian Port Authority, following precedents in other economy, where government actually part commercialize part of their port operation. You know, we see what the likes of Dubai are doing, Senegal also, in terms of part commercialization of some of the port aspects and PPP arrangement with the private sector. That also in itself can yield another 1 to 2 billion. Then you look at Nigerians' mission abroad with myriads of assets that are unutilized or just there. Even in the country that I am now, I look at the Nigerian edifice. It's on a hill, the best of town. But if you look at it, you can see the deterioration. And it's so visible that anybody that passes by can see it. So if government can look at some of those things and then extract value from those assets, then the country will be far better for it. So coming back to MOFI, I would say that as a strategic policy, as a policy of urgent attention, the government, through the entity that has been saddled with taking inventory and managing this asset, should immediately begin the process of taking this inventory, listing key assets, and then communicating to us, the citizen, and the investing public, what they want to do with those assets. People have been shouting about commercialization of assets, listing of government assets. I think it's high time the government really looked at that, and then we stop running down the international debt market. We can actually command more respect, better investment projects, enhance our rating if we will put some of our assets to use. I'll stop there for now. Thank you.
Thank you very much, Dr. Bajomo. I mean, you've said it all. The need to unlock value from our oil and gas, railway, rail lines, of course, our real estate spread across the world, and looking at even the operations of our mission, some assets there, and MOFI repositioning itself, giving us the asset register that would bring more accountability on how it's carrying out its activities. The analogy of the NNPC is very clear, and you've joined the advocacy group now for financialization, just like Proshare has always articulated. We need to move from income-centric to asset-centric levels. Thank you once again for your insights, Dr. Bajomo. Now to Architect Ogunleye from the legislative arm. I'll be taking your opening statements for the next 4 minutes. And of course, like the chairman said, it's always good to see what's happening from the legislative arm. We understand clearly that we have about 3 budgets running simultaneously from your perspective, from the legislative perspective, what are your thoughts on this in terms of timely and effective implementation of our budget and avoidance of resource dispersion?
Yeah, take that again, please.
Can you hear me?
Yeah, I can hear you. Can you hear me?
Yes, I can hear you very well, Architect Ogunleye.
Yeah, let me take the question again.
Okay, so I was saying, my question, can you hear me now very well?
I can hear you very well now.
Okay, now, I was saying that Nigeria has 3 budgets ruling simultaneously. So from your legislative perspective, what are your thoughts on this in terms of timely and effective implementation of budget and avoidance of resource dispersion?
Okay. Let me first of all say good morning to the chairman of Proshare, if he's still available. My co-panelists, the doctors in the house, and of course, our efficient host, Otto. I really feel honored to be part of this discussion this morning. And as we speak, we are expecting the 2025 budget anytime from now. 2026 budget anytime from now. And what we have faced in the last 3 years is, almost 3 years now, is what I will refer to as fiscal conundrum. Because if you look at the budget of 2023, which was passed sometimes in December 2022 by the outgone administration, which we met on ground and implemented and was implemented till sometimes in May, and we had to do another budget to take us to the end of the year. There was that transition issue. Then we now had the budget for 2024 and 2025, respectively. 2024 budget, as we speak, has been concluded. So we no longer have the issue of 3 budgets. What we are contending with right now, so let me just clarify that. What we are contending with now is how we are going to ensure that the 2025 budget is concluded before the end of December. It's going to be tough, and efforts are already in place to look at various options. And what is responsible for all this? It is not because government is irresponsible or there are no experts in the house, both in the Department of Budget and, of course, the Ministry of Budget itself. You know, we have a budget office and we have the Ministry of Budget and Planning. And then, of course, we have the Ministry of Finance and the coordinating economy ministry. So everybody is involved in this matter. By the time you look at some of these issues about budgets rolling into each other, you know, ordinarily government has what it calls MTEF, which is like most of the 3-year budgets are always rolling into each other. But this one happens because of revenue inflow to power the budget in the face of very serious economic reforms that are taking place, majorly up till now in the monetary environment. It's now that we are going to go into fiscal from next year when the new tax law comes into effect. So you have a situation where government is very, very enthusiastic. They want to do so much, and they have put a lot of hope in the budget projections. Let me quickly add also that as part of the chairman and the lead research man spoke about earlier, they spoke about geopolitics, both global and African. You will imagine a situation where you projected your oil sale to be coming in at about maybe $70-something. And right now we are in $60 territory. The other thing is what you are able to sell in the market, maybe 1.3 million barrels per day. And so the citizens don't want you to take a lot of loans. They say that, oh, we said we are going to remove subsidy so as to release a lot of money to the economy. But it doesn't go that way. Don't forget also the inflation effect and the exchange rate effect of all these sums of money that are coming into the hands of the various levels of government. So you now find yourself in a situation whereby the budget meant for year one is not yet concluded by the end of that financial year, either because the flow of revenue into the coffers of government did not happen in time, therefore releases were not coming. You know, there are 3 steps. When the budget is appropriated, money has to be released, it has to be spent, and then that is when the projects are said to have been done. So when those 3 processes are not happening as predicted, then you have a problem. So this is the point in which we are. But I can tell you that we no longer have 3 budgets in 1 year. The only budget that is being implemented as of today is the 2025 budget. But that budget itself may not be concluded this year. But government is determined, together with the legislature, to ensure that by 2026, whatever is left of 2025 and 2026 are taken together and implemented in 2026. Because most of the things that we talk about in terms of macro not resulting into the expected micro results, because nobody carries out macroeconomic reforms or go after macroeconomic stability because it is nice to the air. It is because you want to improve on the welfare of your people. And that's what the legislature is always hammering on, that whatever macroeconomic reforms we are doing, it must translate to the welfare of the people. If it is not felt in the households, then what are we talking about? So whatever we talk about, reserves are going up, GDP is now 4.4. In the first instance, what is 4.2% to an economy of this size and complexity? It's still low. What we should be targeting actually is 10% and above. Oh, fine, we were doing 7-point-something% in the past, but we can still target that right now, and they will be doing fine. So if we move from even 1% to 4%, it doesn't do much to the economy. And then you also look at our GDP per capita, over 200 million people. If you look at our contemporaries like South Africa, Kenya, and all the rest of them, they are doing far better in terms of GDP per capita. So even though we are number 3, Egypt is now number 1, and the best attraction for real investment in Africa, according to the latest reports. Yeah, moving from number 9 to number 19. So we need to look at some of these issues within the global perspective when we are talking about it. So if you talk about 3 budgets in 1 year, I have just explained to you some of the technical reasons for that. It shouldn't have happened at all, because the law says that there shall be a budget for year 2024. There shall be a budget for year 2025. So there should be no reason why, but then it happens, because Nigeria is in a special state right now. We are going through a lot. At the same time, the president is, introducing very strong economic reforms that will be difficult for most free enterprise economies in the world to even, implement or even try. Some of the things we have done. We have moved from, exchange rate of 460 naira to 1,500. Now back in mid-1400 territory, we have, also removed subsidy in one full sweep. Then, we are now buying petrol for 900 and something naira. So many of these things also affect government because they are also doing what we call supply procedure. People take contracts. Right as we speak now, the contractors within the federal situation are facing a lot of challenges. They've not been paid. So as we are talking about the major loans that we are taking from maybe international community or from the capital market, we are also partnering with contractor loans, which also translates to hardship for citizens. So these are some of the issues that we need to, as we are setting the scene for this conversation, we must also look at what are the challenges of government in implementing these reforms and how does it affect budget. Budget is a legislative instrument, although it starts from the executive, but the appropriation law must be made by the legislature. After it is made, it is expected to be implemented. But if some of your assumptions, the fundamental assumptions you made while you were preparing the budget no longer hold because of the conditions that are beyond your control, what do? So
thank you.
No surprise up to it. Thank you.
Yes. Thank you. I mean, you've clarified the fact that the 2024 budget has been concluded, but you've talked about the role of the legislature in ensuring that we have.
Then the other clarification that is important to make is that once the ratio by the Federal Allocation Account Committee has not changed, that means the states still collect what they used to collect. The federal government is still collecting what they are collecting. It does not translate into higher income relatively. It is still the same proportion. And as we go on in this conversation, I will tell you how much the states received last year and this year up to July, and how much the federal government has received based on the sharing formula. And all these agencies are affected by the economic conditions in which we live. So if you took 1 million naira to build a classroom in 2024, you may be spending 2.5 million to build the same classroom in 2025. Thank you.
Thank you very much. Very clear around the need for fiscal responsibility. And of course, we need to strengthen our macro position. So we'll go to the second round of questions. And of course, for Dr. Paul Alaje, there's a request to be added, get an addendum in terms of a question. So when it comes to your turn, you'll get that. But for this second round of questions, I would like our speakers, co-panelists to take the sequence of 3 minutes each in their response so that we can really maximize the discourse time. So I'll begin with you, Ms. Egwim. The current macroeconomic reforms, according to economists, should be aligned with the effective transmission of social intervention programs. How do you assess the government's effectiveness in implementing this and mitigating the impacts of the ongoing reforms on households and businesses?
Yeah, thank you again for that question. Let me start by saying that the reform path and the social transmission path have not moved at the same speed. And that's really where the pressure is showing on households and businesses. Now, from a macro perspective, the core reforms were necessary. For subsidy removal, FX market changes, tighter monetary policy, revenue mobilization. They've helped to reduce some of the structural distortions, supported what we've seen with the inflation trend, and they've also begun to rebuild confidence, investor confidence. However, the shock to real incomes, working capital, and operating costs has been very significant, and the systems that should cushion the shocks were not fully ready when the reforms actually did kick in. On the social side, I would say that government has taken some steps, cash transfer schemes, expanded social registrars, input support for farmers, some MSME focused interventions as well. These are positive signals, but there 3 issues remain. The first would be timing. So support often arrives long after the shock has hit. The second is coverage. A lot of lower middle income households and smaller businesses fall through the cracks. They are not, for lack of a better phrase, let me say in parentheses, poor enough to be on the social registers, but are very exposed to high transport, rent, and food prices. And then the third would be execution capacity. There's weak data, uneven coordination with states, and limited communication creates mistrust and leakages as well. So for businesses, especially the SMEs, the story is similar. Reforms have created a more rational macro backdrop or landscape, but the day-to-day reality still features high energy costs, FX uncertainty at the firm level, and expensive credit as well. So relief measures have tended to be small, to be fragmented, and sometimes difficult to access. What many businesses need is not one-off palliatives, but predictable operating business conditions, clearer FX rules, more reliable power, and targeted and well-designed credit or guarantee schemes that actually reach them. So how would I assess the effectiveness? I'd say the direction is broadly correct, but the transmission is incomplete. The macro framework is moving towards greater stability, but the cushioning mechanisms are still catching up in terms of skill, in terms of targeting, and speed as well. So if we are going into another phase of reforms, tariffs, cost reflective pricing, further fiscal tightening, then sequencing becomes critical. Buffers for food, for transport, and small business liquidity need to be front loaded, not treated as an afterthought. So I think in concluding, I'm trying to stay within your 3 minutes time frame. Here, the reforms are improving the bigger picture, but households and businesses experiencing the economy at a micro level, not macro, are still they're feeling the pinch. So the next phase really has to focus on tightening that link. So better data. Data is super important because that helps you navigate, that gives you clarity, better targeting, stronger state level delivery, and a shift from short-term relief or respite to productivity enhancing support. That is what I believe would turn necessary reforms into something socially and politically sustainable.
Thank you, Ms. Egwim. I mean, short-term relief to productivity enhancement support, very critical at this time. Thanks for your insights. Now to Dr. Alaje, of course, for the next 3 minutes. I would yield for our chairman to ask his addendum in terms of his intervention. But the question to you is, do you foresee a sustained macroeconomic stability in 2026 to 2027, despite being a period of highly political activities? What, in your view, are the biggest risks of soft-pedaling on the ongoing reforms? I now yield to our chairman to add, and then you respond. Thank you.
Thank you very much, Otto. Just 2 quick ones. First, I appreciate what Architect Kola Ogunleye said. I hope he can, during his answers, he may expand further on that for us to understand the dynamics of how governments work, rather than from how we expect it to work. And so we can see the problem. And I think somebody like Alaje will have a rebuttal to whatever Architect Kola said. But I have two major points I wanted to make. The conversation is so interesting, but I thought I also needed to clarify one. One is to talk to Chinwe, and I hope you go back to Chinwe to explain this. When you talk about translation gaps, the contrarian view is that when you make reforms like this, there is a lag period between when it actually manifests. But you first see the manifestations at the macro level, and then there is a transmission challenge as well to see. But my concern is that, why is it that it is not part of the whole gamut of discussion that household consumption capacity should be a critical component indicator for growth? Because if the household has lost its capacity, how are companies building growth? But it is a pity that what we see is a household is there. 2 things, and I think Chinwe and Paul Alaje especially, and anybody, including Dr. Bajomo, is that when we had the highest food crisis, that's when we saw growth in food businesses in Nigeria. So it tells me that is either there's a problem concerning how we understand data, the statistical economy versus the street economy. I will hope that the panelists, when they are making their comments, can add this insight into it. It's important that we know at Proshare. The second thing is directly to both Architect Kola and Alaje. I understand that the governors will most likely be coming together to issue a release concerning the IFRS rule in terms of the minimum levels in which government is working. It may happen this week or not happen at all. I do not believe that whatever they're saying is okay, but I just thought it was important to explain to you, why would governments be, state governments, subnationals be complaining that their IGR level will be less because the federal government has issued a minimum threshold for charging taxation, when they should understand that these lower level people also do not even have enough money to meet the first question I asked about consumption. So, Otto, without taking much of the time, I thank you for the privilege for me to intervene, which is something I normally do. I do not do, but thank you very much. And I hope the panelists can help us address. Thank you very much.
Thank you to the chairman. Of course, the webinar is very interesting, so we'll get insights like this. So, Dr. Alaje, you have the floor for next 3 minutes. If you can condense the response to the first question.
Thank you, Mr. Otto. Thank you, Mr. Chairman. And I must thank all panelists and, of course, our listeners and our audience for listening thus far. I don't know if this will be possible, but I will speak to the first question, which is the sustainability of this reform, especially as we go into the election cycle. I would want to use these to respond to you: the good, the bad, and the ugly. The good is that will it last? Yes. If you consider the good, one, central bank has shown willingness to balance this inflation and with cautious easing. We have seen that Bureau of Statistics saying inflation is coming down, but central bank, at least of the decision taken yesterday, was to hold rate, not necessarily to reduce rate as many would have expected. Again, we have seen rating agencies saying that these reforms is yielding progress. They are noting the progress, and I've been reading some of the rating agencies report, which is showing that Nigeria might be going in the right direction. Now, that for me is the good or the great. Another one is the fragile fiscal environment. We have just heard from the chairman talking about the worries of the government and subnational. And so when he said that, so the worry here about the sustainability of these is the worry or the shock, the security and humanitarian shock. I know one of the panelists has also mentioned how this is translating exactly into human living standard for household, even though we say, yes, this is yielding a positive result, but people are worrying why this is not. So for me, it shows that, yeah, it might be, but it's really very fragile. It might not be as strong as then more persons are putting pressure on policy and poses major risk. What is my biggest headache? My biggest headache is not 2025. My biggest headache is 2026. If politicians, and I need this, I've challenged all the business reporters in Nigeria at an event organized by one of them, I think the Premium Times in Abuja, I think last week, while I was invited as the keynote speaker. I must say that it's important for us to note, even for those of us here, and if I have other economic watchers here, and I'm happy we have Architect so that I can relate with politicians on our behalf. If politicians for 2026, 2027 share dollars as their culture have remained, honestly and sincerely, after election, we will be faced with the same challenges, maybe more, maybe less, maybe the same, but there will be challenges that will be faced with if this remains. For the first time in research history, we're not saying don't give your delegates money. They've come from far and wide, or you want to talk to them, you want to get them accommodation. I don't want to go into the politics of the elections. I want to go into the economics of the elections. Please let us stay with the Naira. Demand for dollar will send wrong signals to the stability that we're experiencing. And once exchange rate changes, one never goes weaker at 1,450, 1,430. If the politicians decide to demand for it at parallel market, and that makes a lot of this. Honestly,
Be ready for higher food prices. Be ready for high transport costs. Be ready for high cost of rent. Be ready for higher school fees. Be ready for higher school uniform. Be ready for higher everything. This is my worry regarding whether this is sustainable or not. But what will I say? Because this is a stress test will come 2026, 2027. With these major biggest time we spend the most. If you check Nigerian economy from 1999 to 2022, 23, you see that for most part, pre-election year and election year is where we post higher GDP score, higher GDP growth rate for most part. So if you are not careful and dollar dominates the conversation, we might be going back to Egypt. Now, speaking to what the chairman has said regarding the number, you see, I think the sample that we are taking currently, I think it's about 1,000 or 1,500 or 2,000 thereabouts, which of course is supposed to be sizable enough, but whether they are representative enough, it's a different conversation entirely, as this is not directly showing in some instances what the number, what the a priori expectation of what the number should be, is not directly showing it. So, but that said, Nigerians also need to know that methodologies are changing, or as a matter of fact, methodology has changed. Number of persons I reported, I remember I was invited to ICANN conference as one of the lead speakers. And after, when I was presenting, I mentioned that Nigerian unemployment figure is between 4 to 5%. I saw how accountant responded by saying, "You've been paid." I said, "Look, they said, but he told you that cannot be the number." I said, "Listen, what is the methodology?" Just like the methodology for inflation has changed. Before now, when we measure unemployment, we were using 20 hours a week. I think before 2014 or 2016, it was 40 hours a week, which we are used to our culture, 8 hours of work per day for 5 days. But that change, of course, in 2014 or 16, to 4 hours a day, that's 20 hours a week. Now that has now changed to 1 hour a day. So if we say unemployment for 1 hour a week is 4 to 5%, it will make sense. But people need to know that the methodology has changed. For inflation, methodology has
Dr. Alaje, maybe we'll get back to you, but very clear from what you've said, the methodology, the actions of politicians, and of course the CBN reforms has made its impact, and there's need to track those pre-election activities. Thank you very much. Let's get to Dr. Bajomo. In our recent webinars, most participants, our recent webinars has featured economists, seasoned economists actually. They've stressed the need for a robust investment policy. Will you say that the series of legislative acts across industries in the market is a sign of progress in positioning Nigeria to attract foreign direct investment as a leading destination in Africa? What are the missing links in our current approach? And you may want to add 1 or 2 response to what our chairman has raised in 3 minutes. Thank you.
Okay, thank you very much. I really don't know which one to start with yet, whether to answer my question or give my own opinion on the question, but maybe I should answer my question first so that,
yes.
Yes. Okay, so in terms of Nigeria's investment policy, I would say that there have been a lot of deliberate actions that the government have taken that have been geared towards stimulating the level of investment and enhancing the investment landscape in the Nigerian economy. I would say the most notable is the recently passed Investment and Security Act of 2025, the ISA. And the ISA, the broad objective of the ISA is to promote economic growth, enhance investor confidence, and also protect indigenous investors, whether indigenous or global investors who have come into the economy. What are the key features of this act? Because if you don't know what is governing the investment landscape, it's very difficult for you to check whether the government is on the right trajectory or they are on the wrong trajectory. One of the major things that have disrupted our global landscape, including Nigeria, is the advent of crypto digital asset. So what the Investment and Securities Act have done is to bring the crypto asset market, the digital asset market, the tokenization market onto the broad umbrella and under the watchful eye of the Security and Exchange Commission. With that, at least everything that happens in that market is now to be moderated or visualized by the Security and Exchange Commission. That is absolutely very positive, given that before, the crypto market, the digital asset market was just existing in its own space with the lack of understanding, even by the regulatory agency. That can have a negative transmission impact in an economy where a segment of the market is actually virtually opaque with nobody understanding the impact. And that's why you see a lot of Ponzi scheme, which has taken close to 2 billion from Nigeria between the early 2000s to date in 25 years. So that is one major thrust of the Investment and Security. Another thrust is the establishment of the Investor Protection Fund, which is geared towards protecting the investing public and mitigating or minimizing the advent of fraudulent activities. What we've seen is a lot of unlicensed players coming into the market, robbing Nigerians of their hard-earned money, selling things that are arbitrary. It takes greed to patronize some of them, but they are able to sell, and a lot of us get burned in the process. And then one thing the Investment and Security Act also do is to modernize the risk management architecture in terms of how the investment landscape is governed. And then to bring a lot of transparency onto the investment landscape through the legal entity identifier mechanism that's set up. So you cannot be a player without having your unique legal entity, the corporate registration that identifies you so that you can be traceable. And then the absolute prohibition of Ponzi. And you've seen the Cybex, all of the events that have happened. You've seen a lot of enlightenment campaign by the Security and Exchange Commission. And then renewed focus on capital market. I mean, we're talking about 1 trillion economy. So the capital market, like I said, has a lot to do in terms of how Nigerians get there. Some of the actions of government in recent time, I don't want to rehash them in terms of the monetary policy, the fiscal policy that have helped us to move from the repressive monetary regime in terms of weaponization of CRR in past. If you do something that the regulator does not like, your CRR moves from 25% to 50 to 70 to 100. All of those have been moderated, and I think the central bank and the government deserves a lot of commendation in that regard. FX liberalization has also helped. Now we're talking about Naira stability. It has helped to also do what we call price discovery, the process by which people who are trading or coming to invest in Nigeria, the FPI, the FDIs that are coming, that can project and formulate what rates should they exchange Naira for dollar at. And that's where you've seen a lot of acceptance, and Naira now becoming a proper medium of exchange and a store of value. We're not where we should be, but at least we're on the right trajectory. A major policy and investment drive initiative also is the e-invoicing that is now linked to the FIRS system. Yes, some of the players might not like it because it brings a lot of transparency, and it means that nobody can really exist without being known, and that the government is able to track its revenue. And then the bank capital raise has contributed to the deepening of the debt and the breadth of the capital market in Nigeria. We've seen a lot of banks come to the market, and that has also engendered confidence. So what we have had with a myriad of this policy is that we've now moved to a period of stability in macros and a period of fiscal stability as against cost-led initiative and investment strategy that we were doing before. However, like it's been said in the conversation, corruption is a major factor in this regression equation. Corruption is what can make or make some of the policy. With the economic pressure that have happened of recent, the level of corruption, if we'll be honest with ourselves, has gone up. Things that before you could move from one table to the other, whether in private or public sector, more pronounced in the public sector. Nothing moves except something happens. And I think that is something we as citizens and as a nation, we really need to focus on, but it has the potential to draw us back, because if people can't get anything done without having to do PR and factoring some things that are not in line with global best practices into their equation, it would affect the investment landscape. What is the missing link? To go to your question, The basic major, the missing link number one is the government attempt to support the real sector. I must admit that the government in recent time, with the abolishment of the intervention fund scheme, which in itself was not bad. Yes, some aspect of it might have been abuse, cronyism, benefiting some sector versus the other. But the government needs to, and then now the Bank of Industry is coming out with subsidized interest rate for players in the real sector, some women-led organization. But the government needs to be more definitive in terms of its support to the real sector, because the real sector is what the sector that bears the brunt. Yes, because some corporates want to be in the good book of the government. They might not openly complain, but people are feeling the pinch because now you are moving from the exchange rate that liberalization. We've moved from 358 in 2020. We've moved to 1,400, 1,500. Thankfully, we came down from 1,900. Now the tax environment has been heightened. Yes, the government is right to want to improve the tax to GDP ratio, but it takes a lot of impact on the corporate player, the real sector, the manufacturers, and then the transmission effect to the purchasing power, the disposable income of the citizen of Nigeria. And that's what I understand what Mr. Awoyemi is saying. Sometimes you cannot even phantom the transmission of all of this policy impact. It seems like the policy impact, if we don't watch it, is now an least impacting policy regime, and then the mass impact is left to chance, and then for people to just survive. But you know, Nigerians survive, and anyhow they survive. If you don't believe Nigerians survive, look at the airspace, the airline sector. We've moved from the days of buying tickets for, to London for 300,000 or so to America now. Sometimes you pay 5 million, 7 million on economy. Even in business class, sometimes you pay 12 million. But go to the business class, there are no space. Everybody, and then you look at people. What's happening? Are they not feeling the pinch? Where are they getting this money from? Then talk of the first class. So Nigerians are surviving. I think the citizens are surviving. Sometimes we just find ways around surviving, and they thrive because people then do more, they explore other opportunities. But does it mean the problem is not there? No. A lot of people have lost their disposable power, and a lot of them are just living on the trenches. So the government really needs to do something to impact the masses directly. Not just Nigeria by a construct. We're not people that live on handouts. Nigerians are proud people. They don't need anything from the government except basic amenities, the road, the good hospital network. So we're not used to looking to the government. So this is an aberration in the Nigerian landscape. But as people are surviving, so that you don't have something like a mass revolt that just starts, you really need to look at the transmission from policy to the citizen. What does the government need to do to make sure that, and it's not in giving 50,000. 50,000 will not buy anything. 100,000 is less than $10. So it's $100, sorry. It will not do much for the citizen. What you can do is build roads, engage in mass transportation, subsidize the fertilizer so that the agricultural costs can go in. And, in subsidizing.
Thank you, Dr. Bajomo. It's very clear what you've said. The transmission between policies is important. Do we have you back now? Okay. Okay, so it's very clear what you've said, the need to bridge that.
Country like Zambia. Okay.
Yes, you've highlighted the key issues, and we appreciate them.
Sorry, I didn't get that.
You've highlighted the issue of subsidizing those key levers that can really improve the transmission of policies to the mass. Transportation, issues around food production like inputs, fertilizer. Those are very critical interventions that can help. And you said that government should look at the real sector in terms of how they can really finance and unlock those areas. So thank you for your interventions. We appreciate. Now we're going to the third round of questions. We're supposed to have Architect Ogunleye, but we hope to have him in the next round. The third round, we would be taking responses for 2 minutes because we know that our time is beginning to wind up. Ms. Egwim, from your interaction with the global community, look at the whole geoeconomics and what's happening with the presentation from Mr. Ige and the comments from our chairman, what are the priority sectors for Nigeria in 2026 as we see the global race for attracting capital? And what additional layer to the ongoing reforms are critical?
That's a super packed question. I'll try and answer it from my vantage point. Okay, so yeah, and then towards the end I will touch on what the chairman threw at me. So from what I see in conversations with investors, development partners, and just the diplomatic community, especially Europe and North America, which I'm currently at, capital hasn't disappeared. It has simply become more selective. So for countries like Nigeria, the question is no longer how do we get money? It's how do we signal that we are serious, investable partners in a world that now has tougher choices on the back of some reforms that we've seen come out of the Trump administration. So I think I would frame it around four things. One, predictability and policy credibility first, then incentives. So global investors, whether DFIs, whether pension funds, whether it's impact funds or corporates, are all saying the same thing. They can price risk, but they cannot price uncertainty. So consistency of reform direction is very much important for them. More transparent ethics and regulatory frameworks, professional data-backed engagements with investors as well, not just roadshows and announcements. When the rules feel predictable, the conversation very quickly shifts from if we invest or how we structure this investment. I think the second pillar would be shift from projects on paper to bankable, well-prepared pipelines. And a big gap that I see is not the absence of ideas, but the absence of bankable pipelines. So to attract capital to emerging markets, Nigeria inclusive, we need to prepare properly structured projects in energy. So I'm talking about the sectors now: transport, digital infrastructure, housing, agro-processing, and climate adaptation. There's a lot of interest in the climate space. I think I would also throw in mining to an extent as well. I think another thing to mention is to resolve basic issues early, things like land, permits, counterparts, funding, governance, and revenue models. We also need to consider using visibility gap funding and guarantees where appropriate to de-risk commercially sound projects. Global capital is honestly is sitting in the funds that must deploy into emerging markets. And as I mentioned, climate is one, infrastructure, gender is still at the forefront, digital, but they all gravitate towards places where the homework has already been done. The next would be de-risking intelligently, especially around FX and governance. Most investors I speak with are not frightened by Nigeria or by Nigeria's growth story. They are just cautious about three main things, which is FX risk, governance risk, and execution risk. So the tools that would matter here, or some of the tools, not this is not exhaustive of the list, would be partial guarantees and blended finance and risk sharing facilities to soften FX and political risk. Stronger governance and reporting standards as well at project and institution level. Obviously, audited accounts, ESG frameworks, proper boards are also very much important. And then there must be a clear pathway for exit, whether through local capital markets, whether it's trade sales or refinancing. When investors see that the risk is being shared and governance is being taken seriously, their appetite improves, even in this current global economic situation that we're in. I think the last would be leveraging closer capital. So it's not just capital that's coming from advanced economies. There's capital from a regional perspective, diaspora and local institutions. So it's also important to recognize that the next wave of capital for emerging markets, Nigeria inclusive, will not come only from, let's say, New York or London. We have opportunities with African and regional funds looking for skill in West Africa. There are opportunities with diaspora investors who are more comfortable with Nigeria's story but need credible structures, not just making decisions, investment decisions based on emotion. Domestic pension funds and institutional investors are very much important. I'm currently closing out on on the projects around that. And these players can anchor transactions if the policy and risk frameworks are right. So if we blend local and regional capital with global capital, we send a powerful signal that we are willing to invest in our own story, and we are inviting you to join us, not to rescue us. So I think in summary, the countries that will attract capital are not necessarily the ones that have the loudest narratives, but the ones with the clearest rules, the most credible pipelines, and the strongest governance signal. So if Nigeria leans into those three, we can still be a meaningful destination for capital in the year ahead, regardless of the current global economic situation with regards to capital tightening. So now segueing into, I'll just maybe one line or two lines. I think based on what the chairman, his interventions, and what he spoke about transmission and penetration, I would say to an extent, data is not, and this is not the first time I'm saying it, I don't think that data is fully reflective of market realities. We have to understand that Nigeria is largely driven by the informal sector. When we're looking at national accounts, it's the formal structure that we're looking at, right? So that is on one hand. I'm not, by no means am I diminishing the work that's being done by the Bureau of Statistics. They're doing an amazing job. But Nigeria's economy is largely driven by the informal sector, and what we report, what we discuss when we're having professional formal forums or forums like this is the formal structure that's captured in the national accounts. Okay, so there's data distortion in my opinion. So that is one level of the response. I think the second was, why are we not carrying every stakeholder along? Or well, not we, because I'm not part of the government, but why weren't every layer of stakeholder carried along? I think again it depends on I don't want to be, let me put it this way. Based on some of the engagements I sat in, I did see a lot of stakeholder engagement, but I feel like there was room for improvement. I feel like the time frame to engage stakeholders to actually see how social intervention cushions could be formed before those policy reforms were announced was very short. So I think more time may have allowed for more engagements, which could have proffered workable solutions. But at the end of the day, somebody would have still felt the pinch. It's almost like pain. One must feel pain in order to get to relief. That is how I see. Yeah. So
Thank you
yeah.
very much. Thank you, Mr. Egwim. I mean, it's clear the clearest rules, credible pipelines, and of course, governance frameworks are important for investments. And there's very clear need for data, especially capturing the informal sector. This conversation has been very interesting, looking at how we can really capture economy and transmissions. All right, so I'll go quickly to Dr. Alaje. And Dr. Alaje also condensing into 2 minutes. This is a follow-up to the last question, but we're now looking at the harmony between fiscal, monetary, and trade policies for economic sustainability as we are approaching a pre-election year. How critical is that, especially keying in the trade component into the alignment?
Well, economics stands on 3 legs. Thank you so much for the question once again. All economies stand on 3 legs. Without having, I mean, if one of them is missing, imagine when you have someone with 2 legs, but one is maybe a stick or something for the person to walk, normally. The same thing with economies. Economies stand on 3 legs, majorly the ones that are obvious, fiscal and monetary. Then the third component is the trade component. We have seen effort from monetary authorities, to heighten rate in recent time to reduce rate. Fiscal authority, what I hear in the news, which of course have been confirmed by architects this afternoon or morning, is that we're expecting the 2026 budget to be presented. And the subnational we also have there. As we know, the biggest thing that will happen next year is the tax reform. It's going to be a tax year, or a year where we're going to start implementing some of those things that you've mentioned. So connection is what matters in all of this. When you increase taxes, I'm not saying we have increased taxes, but when you increase taxes, it's a withdrawal effect. If you are raising interest rate when tax is going up, then it might also affect growth, because it's a withdrawal when you use national income accounting as a basis for analysis. So it's important for us to see that synergy between the two. What we should see, however, is that fiscal authority ensure investment that will necessitate exports. And when you do that, you are going to see more inflows that will inform monetary authority in terms of reserve increasing and exchange rate stability in real time, without authorities trying to protect the naira, as the case may be. So these three arms must work together. And when I say work together, I'm not limiting this to Central Bank of Nigeria or Ministry of Finance. I didn't say that, I mentioned authorities, because whatever happens in maritime will also affect our exports. Whatever happens in maritime will also affect our monetary decisions. So I left them as broadly speaking, these three must interact, and agencies of government and private sector that are affected must also be get that support in terms of policy support, in terms of investment support, so that we can see a relatively stable economy in the coming period.
Very important. The interaction is very critical between the three arms of government, which you said the government is on those three legs. Dr. Bajomo, I heard, of course, you've heard Ms. Egwim talk about credible pipelines of project financing, moving from paperwork to effective bankable projects. What does Nigeria need to do better, especially in this area of capital project financing? There are concerns about why we're not ramping up channels to attract private capital to fund key infrastructures that will support growth beyond annual budgets. What can be done in this regard? Your response in 2 minutes.
Okay, thank you very much. So in terms of economic reform and capital project, capital project mobilization, I would say number one, in order to drive capital project financing and drive the resources required to finance those projects, number one, Nigeria needs to establish the right legal and policy framework. The days of policy inconsistency, policy somersault, arbitrary change in policies should be behind us if we are serious about mobilizing capital to finance significant investment spanning decades or years. We have to have respect for public-private partnership engagement. If we change, disruption to policy leads to a situation of trapped capital, because until those disruptions are removed or addressed, capital ends up being trapped. We, as a nation, we need to formulate policies that makes Nigeria so attractive that it cannot be ignored. A must for prospective investors. What better example can I set in terms of impact, quantum, and timeline than the recent, February 2024, 35 billion investment by the Dubai Sovereign Wealth Authority in the economy of Egypt. That transaction is so profound in terms of timeline, impact, and the ease of operation. So the Dubai Sovereign Authority took a decisive step to say they want to invest in the Ras El Ekma, Peninsula. The first tranche of that deal is that within the first 2 months, a total of 25 billion will be disbursed to that economy. 2-month timeline. Then the second phase is that, okay, funds that have been invested in the Egyptian economy, 11 billion by the Dubai government. They will now move it from foreign currency investment to convert it into local currency to support the domestic economy. Done, dusted, no arbitrariness. It takes a lot of confidence in an economy for you to have such projects. Nigerians bring the pride of Africa, the flagship. In terms of our size, mass, human resource, we need to formulate policy that makes people to take decisive steps to come and invest. There's so many avenues to invest in Nigeria. Another thing we need to do is that no matter the extent of interest, we need to tackle the issue of security. Stability is key. Uncertainty and investment don't mix together. I talked about policy consistency, and then the issue of policy inconsistency, like I said, should be behind us. I'll give you a few examples. In recent time, during the Goodluck Jonathan era, we had an auto policy towards the twilight of that administration that makes import duty on cars, imported automobile, 35%. And then for local assembly, 5%. A lot of people went into assembly, investing in car assembly plants. Then sometimes, true or false, government had interest in importing automobile. And they overnight changed the duty from 30-something% to 5%. What happens to everyone who invested in the assembly plant? That was the end of that initiative. Look at the dairy policy as well. They said every dairy company in Nigeria should also set up Ruga. Everybody started importing sheep, cows from Netherlands everywhere. Where is that policy today? In terms of, so everyone who invested in those things in Ekiti, everywhere, the Friesland, all of them of this world, all of the dairy producers, what happened to those investments? Those capitals largely trapped, and then some written off and forgotten. Then in terms of concessionaires as well, what will make somebody to come and take concession in Nigeria? Look at the MMM airport controversy. I don't even know if it's been resolved to date. Look at the Lagos-Ibadan highway. Take it from somebody, give it to somebody, you don't know where. The Virgin Atlantic quagmire, the PH refinery sale. Had the PH refinery been sold, maybe there will be no Dangote refinery today. So those are some of the policy somersault and the impact they have on the economy. If you are looking for an example of confidence in Africa, let me not use Egypt, North America. Let me look at West Africa. Look at the Sierra Leonean airport, where we were all at home during COVID. The government of Sierra Leone entered into a partnership with Suma Group of Turkey. Suma Group was mandated to construct the airport, $270 million. Nothing parted with, off-balance sheet engagement, no debt recorded on the balance sheet of the government of Sierra Leone. The airport was completed in less than 2 years. It was commissioned in November 2021. It was commissioned by May 21st, 2023. That is what PPP can do when there is investor confidence, when the policy architecture is well there. That airport is arguably one of the best in West Africa, in Africa. And, you know, the concessionaire framework is on the internet. You can look at it. It's 12 to 5 years, clear policy laid out. They are collecting their taxes. They are collecting it at the airport. They have 25 years, and then they hand over the key to the government of Sierra Leone. Somebody else is already doing an extension of a bridge to that project. When do we begin as Nigerians, given all of our resources, our profile, our GDP structure? Look at our GDP versus the GDP of Sierra Leone. If Sierra Leone is able to command $270 million to finance our airport, we can do better. We have been doing ours by ourselves, different people. You know, we don't even know who has constructed the airport. I think if we can address policy, we will go further. Thank you very much.
Thank you, Dr. Bajomo. Quickly, we would take 2 questions, and then we would get to wrap up, take our poll, and of course, as we wrap up. Thank you very much to our panelists for very robust interventions. Let us first begin with the question from Adenrele. We also know that Mr. Architect Kola has been trying to connect. So once we get him back on board, yes, we would ask his questions. The first question is from Adenrele, and I will direct this to Dr. Paul Alaje, just a 1-minute response. Adenrele says that it's interesting to note the economy indices in Nigeria, where the indices appear to be on the upward tangent. How does the government, business, and other sectors of the economy begin to reflect on the main street when it actually affects the man on the streets? Just 1 minute response.
Okay, so it's the impact of improvement in economy. We first have macro effects. It takes time before it starts going to micro effects. And when I say micro, I'm not just referring to individual. It starts with the impact on government. In this time, I mean, in this case, government has an immediate impact. But as the investment happens at the subnational, at national level, businesses will start feeling the impact, and eventually it will get to the households. So it takes time. It's not going to be automatic. But if it were to be another round, which government have taken, which is direct support for businesses, that is what you see as impact. But that in itself has its own major disadvantage or disadvantages, as the case may be. So, but the impact will come if we remain steady, if we remain focused on the policies. It will certainly have its impact, but it will not be immediate. Thank you.
Thank you very much, Dr. Paul Alaje, for your response. And then for Imawolo Moyeni, I'll direct this to Dr. Bajomo. Just 1 minute response. From Mr. Paul's assertion, what may likely be a pragmatic measure to curtail the use of dollars-induced election, its infiltration and its adverse effect on the economy as mentioned? What can be done to curtail this pre-election activity?
I think that will likely be a deliberate strategy on the part of the government and the politicians. So we've seen government arrest people because they spray money, they do that, and people get prosecuted. The whole nation has seen it. So it's now behold on the government to put in place the right legislation, defined, articulated, and enforced. If the government is able to do that, then that would likely be curtailed or minimized to a BRS extent. But the only challenge is that the biggest culprit as 2027 approach might actually be the enforcers of the law. So that is it. Thank you.
Thank you very, very much for that incisive response. So I would like to take in 30 seconds each of your response in terms of the concrete outlook for Nigeria's economy. We've heard about the recovery from risk. So what are those key trends that we should watch out for, track, and plan for? You can condense that in 30 seconds. I'll begin with Ms. Egwim. Ms. Egwim, can you hear me?
I can hear you now. What did you say? I didn't hear what you said.
Just to condense in 30 seconds, the concrete outlook for Nigeria's economy in 2026, with the recovery from risk, what are those trends and developments we should watch out for, track, and plan for? In 30 seconds.
Wow.
Yes.
Okay. So we're going into a pre-election year, and pre-election years they always test. Sorry, I don't know if my video is on yet. Okay. They always test economic discipline, and 2026 will not be different. So the most likely outcome is what I would call managed stability. Growth would stay moderate. Inflation continues to ease cautiously, and FX remains broadly within a range as long as the reform path is not abandoned. But there is also a credible downside where political spending accelerates, investor caution may return, and FX and prices come under pressure again, especially if reform signals weaken. I think on the upside, I would say a decisive post-election mandate could unlock renewed reform ambition, strengthening credit flows, deepening diversification, and just lifting business confidence in general. So this is a year for clear-headed planning, anchor strategy around stability, hedge against political spending risks, and keep optionality open for the upside. Because Nigeria's trajectory next year will depend less on new policies and more on how consistently we execute what has already started. That's 30 seconds.
Thank you very much, Dr. Paul Alaje.
Okay, well, thank you so very much once again. I expect a modest recovery around 3.5 to about 4.7% GDP growth rate for 2026. One, because it's a pre-election year, and I expect expenditure to expand. Even though IMF has a revised rate of about 4, IMF World Bank 4 to 4.2, but to my mind, it's better to keep it a bit wide at 3.5 to 4.7, favoring the upper limit. I expect headline inflation to remain lower because we will be expecting the base year effect. We might see a point of reflection around the second quarter. That will be between April and June next year. External reserve is expected to be around 40 billion to about 55 billion for next year, if central bank continue to intensify the current policy. Then for fiscal space, it's important I stress this, the fiscal outcome remain at the main wild card. One, because pre-election spending, if it widens the deficit, then I can tell you that the room for policy maneuver may shrink and the cost of financing may increase sharply. When this happens, you know what it means. It means that in the short run, government cost of borrowing, cost of service would increase. When that happens, eventually you might have the impact on your exchange rate. You might have the impact on your exchange rate as well as on inflation. Overall verdict for me, the stabilization is possible, but the stabilization is still fragile until and unless we make cautious efforts to ensure that this recovery we are seeing, it's really still very fragile, and we need to look at the downside risks and ensure that we protect ourselves against policy reversal, FS shock, food security, and human security, as we have seen. Most importantly is we need to ensure that before the end of first quarter next year, we try everything possible to minimize every ugly head of insecurity that we have seen. Because if we don't, it might send negative signals as elections are coming. Spending may increase. Spending is spending, whether it's because we want to fight insecurity or because we want to spend into capital expenditure. It is seen as spending. However, the interpretation eventually may change when we are putting money in infrastructure. It might not necessarily induce inflation, but as it is, we need to put in more effort in combating human insecurity in Nigeria, as well as its effect on food inflation, so that we don't have to have policy reversal. Thank you, and God bless everyone.
Thank you very much, Dr. Bajomo. 30 seconds.
Okay, thank you very much. So the ratings agency have already indicated the direction of travel. In terms of the outlook for the coming year, I would say it's positive, but it will be, there 4.2 projected, will be moderated by the underlisted. Number one is the geopolitical play. We live in a global economy and we are impacted by global activity. So the discussion around tariff. On the altar of tariff, you have some of our key partners, India, China, United States, and the rest of Africa, and even Europe. Between those three countries, you have over 45% of our import strategy. And then in terms of export, around Europe, from Europe, we have over 45.5% of our export, which is largely oil to those markets. So how the tariff structure is resolved between the United States and the rest of the world will affect us. Then in terms of the oil play, sanction on Russia is positive for us because then the Russian oil will not come into the market. If the sanctions are lifted, it's economically negative for us because that reduces demand and it depresses the oil price further. Status quo is good for us. Security, the designation of Nigeria as CPC is something, as government has done, we have to take seriously because any sanction resulting from that affects the level of trade that we can record, affects the surplus that we can get from balance of trade, affects how people see us in the world. The politics element, politics and inflation, they go hand in hand. So if election is coming and money pumps into the economy, how hard will government have to fight to rein in inflation and the impact on the exchange rate? Economically, the new tax implementation comes in focus by January next year. It has a lot of impact on individuals and corporate and the citizens alike. And then the delayed 5% fuel surcharge, which was delayed on account of agitation, is supposed to take effect from January as well. Are citizens well positioned to be able to absorb that, or there will be some distortion or instability from riots and protests by the Nigerian Labour Congress. Then banking sector capitalization is coming to a conclusion in that year. It's largely done, but the insurance sector is a sector that we must watch and look out for major consolidation. And so in terms of retail trade, the retail space, the real sector, let's watch out for what happened in the retail space market. You can see a lot of the foreign players in the retail space struggling, where the indigenous ones are thriving. Would there be policy moderation that allows the foreign one to thrive as well? And then in terms of social media impact on the economy and what the fifth, sixth economy can bring, let's look out for what happens in fashion, in the media space, the music, the food sector, like Dr. Awoyemi said, the impact of what happens in the food sector, and then corruption index. Any growth in our corruption index in terms of what happens with election or the current level of economic activity will have a negative impact on perception of Nigeria, and it has a negative impact on the ease of doing business, and it can affect investment sentiment. So on balance, the direction of travel is very positive. The government has done a lot, but they can still do more in terms of impact on the serious economy. And in closing, I think it's high time the government begins to look at fresh real sector player, new minds, fresh faces that can impact economic activity. Enough of recycling. We need to have fresh minds, young minds who can also contribute their quota to economic landscape in Nigeria. The president has tried, but in terms of economic population, in terms of the economic committee championing the affairs of this nation, we definitely can do with fresh mind. Thank you, everyone. Thank you very much.
Thank you, Dr. Bajomo. I like the last part, rejigging is very important. Okay, so I would like to appreciate everyone. We'll just quickly, in the next 30 seconds, do our last poll for the conference. Then we would like our co-panelists to put on their video screen so that we can take a photo, and then we'll wrap up this conversation. Thank you very much. Our final poll. Thank you all for participating. We really appreciate the participation throughout all our polls for this conference. So now I'd like our speakers to put on their video so that we can have a photo up for this conference. Really appreciate you all for making our time for this. Thank you very much. I would like to appreciate our esteemed speakers for making this conversation worthwhile. I mean, the combination we've had today is quite impressive, and I'm really glad that you all created time to be here. It was interesting to have Architect Kola Ogunleye, an architect, chartered accountant, and a Senior Legislative Aide at the House of Representatives. At some point, we couldn't reconnect with him, but of course, we will have him to give us further insights. We will then get some further insights on his perspective from the legislature, which is very important. We also thank Dr. Bunmji Bajomo, a Pan-African banker and a financial advisor. Very insightful perspectives you brought today. Dr. Kola Alaje.
More than insightful.
Thank you, sir.
Dr. Paul Alaje, like our chairman has said, an economist.
Dr. Paul Alaje, put your video on the activist economics.
Very interesting conversations and perspectives from you.
I'm not an activist. I'm not an activist. It's just that, no, I don't do any activism. When the things are not very well done, I mention them. And in recent time, I've given a lot of recommendations to authority for policies formation. For instance, when we floated our currency and at the same time we removed subsidy, I knew it was going to have effect on the economy. And I mentioned all those. But today we have left absolute flotation of currency to manage flows, and I've since commended authorities for taking those decisions. So, but if it's not well done, it's important for us to say, because for those of us in research and those of us in public advocacy, we are quick to just not say anything. But that's how what got us here. Government printed trillions of naira in ways and means because we did not speak, and it may still affect us further in the coming period. Thank you, sir.
Okay, Dr. Alaje, we'll take up this conversation offline. It's quite interesting. And most especially, I must appreciate Ms. Chinwe Egwim. She had to take out time from her time zone to be part of this. I really appreciate you, Ms. Egwim, economist and World Economic Forum global leader.
The code is helping her. The code is helping her.
Thank you so much for taking out of your busy schedule to make this conversation. And we'd like to appreciate everyone for being part of this. Our audience, we appreciate you, the board and entire team of Proshare and all our key stakeholders for being part of this conversation. Just to inform you that Proshare will be unveiling its 2026 Outlook report very soon. You've seen a tidbit of it from Mr. Tosin Ige's presentation. I would like you all to look out for it as you continue to engage our platforms. You can follow our website, www.proshare.co, or send any of your inquiries to research@proshare.co for further insights. Thank you once again for being a part of this conference, and wish you a great day. Thank you.
Thank you.
You have to talk after this meeting. Yeah, me and you have to talk. Great points. God bless you.
Thank you so very much, sir. Thank you.
God bless you. And thank you, Tosin Ige. Thank you for all.